They say that the trend is your friend till it ends. But how do you know when it ends? How do you know when you should not be looking for retracements and instead go for a reversal play or to skip the trade completely? Well, there's actually a neat trick that you can apply to know when you should not trade a retracement. And as a teaser, this is the first chart and this is the second chart. I'd like you to guess in which scenario you should avoid trading a retracement. And this is actually the answer. If you apply this secret Dow Theory technique I'm about to show you, then your chart will look something like this. And it should be very clear that you should avoid looking for a retracement in this scenario. So, what is this secret Dow Theory technique and how do you apply it? I will go into the details of all these shortly. But right now, please do me a small favor and hit that thumbs up button. If you are new to the channel, please hit that subscribe button as well because we create many valuable trading tutorial videos like this, and I believe with all my heart that you will be a much better trader after watching these trading videos. We also do a giveaway worth $37 for our plug and play trading package as a means to encourage you to watch this video and pay close attention. So if you wish to take part, look for an emoji somewhere within this video. You can also find the full instructions in the pinned comment down below. Now, the Dow Theory is a very comprehensive theory and there are a ton of information about it. You will find books, videos and even courses about it. But in this video, I will simplify everything and just explain the portion that you need to understand for this technique. You don't have to know everything about Dow Theory, nor will I bore you with all the details that isn't practical. Remember, we are after the practical aspect of trading and making money. Over here, I extracted the following statement from Wikipedia. And as you can see, the Dow Theory states that a retracement should be between 33% to 66%. Logically, if a retracement should be between 33% to 66%, then any retracement past 66% would mean that there's a high probability that the market is doing a full reversal rather than just a retracement. This is the secret that other Forex channels won't tell you. They may explain what Dow Theory is and just regurgitate what they found on Wikipedia or other websites, but they won't show you the practical aspect of it. And that's another great reason why you should smash that subscribe button and turn on the notification bell if you have not already done so. Why? Well, because we do our best to give you practical steps. So now that you understand the theory, let's get practical. How do you use this knowledge? What kind of tool should you use? All this good stuff will be covered next, so keep watching. Now, to measure the 66% retracement, we can pull out the Fibonacci retracement tool. Now, because 66% isn't a Fibonacci level or a typical value used by most traders, we will have to input it ourselves manually. So just pull out the settings and insert the 0.66 level, which is the same as 66% retracement level. You can go ahead to remove the other levels as well so that it is less confusing. Just keep the 0 and 1 level as these levels will help us see which swing points we are connecting it from. I have previously uploaded an ultimate guide to using the Fibonacci retracement and extension tool. If you are new to trading and don't yet know how to use the Fibonacci tool, then please check out that video after this. I will leave a link to that video at the top right and at the end screen of this video. But for the purpose of this video, I'm going to run through it quickly and assume that you are already familiar with this. So to determine whether we should be trading a retracement or not, we want to use the Fibonacci retracement tool to measure the recent swing and whether price has broken the 66% retracement level or not. Let me show you what I mean because it's much easier. Right here, we have an uptrend and a recent swing right here. And because price is in an uptrend, Then we connect the Fibonacci retracement tool from the swing low to swing high. In this case, we can see that price breaks the 66% retracement level. When we see this, then we want to avoid trading a retracement. So this is how we use the Dow Theory in a practical way. By the way, a quick tip for you if you struggle with identifying the swing highs and lows. You can switch to the line chart and you should be able to identify the swing highs and lows easily. Just remember that you should be drawing the Fibonacci retracement tool on the candlestick chart and take into account the highs and lows of the candles. So here's another example. Here we have price in a downtrend. So we look for the recent swing low and plot our Fibonacci retracement tool from high to low. Now you can see that price retraces and violates the 66% retracement level. This is a sign that you should not attempt to look for a retracement anymore. In this scenario, price eventually goes higher and we see a market bottom. Now that you understand when you shouldn't be trading a retracement, let me show you the opposite, a scenario where you should be trading a retracement. So right here, we see that price is in a downtrend and price retraces. Now to determine if this is a retracement or reversal, we pull out the Fibonacci retracement tool and connect it from swing high to swing low. And what do we see? We see that the retracement didn't violate the 66% level. Thus, in this case, we can go ahead to trade the retracement and not assume that the market is ready to reverse. So it's actually pretty simple. Just use the Fibonacci tool and look at the 66% level. But a word of caution that this is not a full trading strategy. This is just a small trick to determine if you should be trading a retracement or not. If the answer is yes, then you can carry on trading a trend following or retracement strategy. And if the answer is no, then you can either not trade or use a reversal trading strategy. Though I would advise you to stick to not trading it. Please do not use this trick and start trading reversals whenever price breaks the 66% retracement level. That's not the purpose of this trick, and this is very important. Feel free to combine this with any of the trend following strategies that I teach on this channel, but please do not blindly trade when price breaks the 66% level. Another thing to note is that this is just a quick and fast way to discern if you should trade a retracement or not. I'm aware that there are some Fibonacci traders who look to trade off the 0.768 level. In fact, in my Ultimate Guide to Fibonacci Trading video, I talk about how you can identify high probability trades at the 0.768 level by combining the Fibonacci retracement and Fibonacci extension tool. So in a sense, this secret technique is not entirely foolproof. But hey, there's nothing in trading that works 100% of the time. And for newbie traders who struggle, this is a very good way to tell at a glance. So summing up, when you should not trade at a retracement, you want to use the Fibonacci 66% level and plot the Fibonacci tool at the recent swing. If price breaks the 66% level, then that's a clue that you shouldn't be trading a retracement. If price doesn't, then going for the retracement is fine. And that's all I have for you in this video. I hope you got value. As promised, I will leave a link to the Ultimate Guide to Fibonacci here at the end screen. Do check out this video next because you need to have a good understanding of Fibonacci in order to apply this trick correctly. And that video addresses how to use it and much more. Thanks for watching. I'll catch you in the next one.